Let's continue now with some other concepts from the chapter that we're studying. Basically what we're doing is we are analyzing regular business transactions, and we are trying to determine what's going on in terms of, we have a business transaction, what parts of the income statement and or balance sheet are impacted. So our first couple questions are true-false. And it says here, liabilities are debts owed by the business. This is absolutely a true statement. Because we said that we said about assets that assets represent a future benefit. Liabilities represent a future sacrifice. And if we're going to be making that sacrifice in the future, that means we have a debt currently represented by the liability. And if you go to the store and you buy a dozen eggs, well, you get to the register and you just pay for the eggs and that's it. There's never any liability. But this is when we have a debt, we're saying, okay, we have an obligation, and at some point we're going to satisfy that. But until we do, we have a debt, we have an obligation. We call those liabilities. Next question says, the unearned revenues account is an example of a liability. What do you think? True or false? Because they're revenues. This is a true statement. So I want you to understand that if we eliminated the word unearned here and we just said revenues, revenues are an income statement account and liabilities are never found on the income statement. So unearned revenues are revenues we've received, but we have an obligation to perform services. So the example that I often use is, say for example, the University of Nebraska sells season tickets, and they collect the money for those season tickets, say in, I have no idea, May, June, July, whatever. But let's think about this now. The first game is not going to be played until August or September, something like that, and then carry on through part of December. So they have the money, but they haven't provided any services. Therefore, that revenue that they've received is unearned. They haven't done anything yet. You've paid, but you haven't watched any games yet. Well, throughout the season, every time a game is played, part of that money becomes earned revenues. So unearned revenues are most definitely a liability because they represent a future, they represent a future sacrifice and a current obligation to provide goods or services. All right. Which of the following statements is not true about liabilities? Well, let's see here. It says, liabilities are debts owed to outsiders. That is absolutely true. Now, I will say this, just to clarify, a business can have a liability to its owners. Okay, that is possible depending on what type of business entity we're talking about. But certainly liabilities are in fact debts owed to outsiders. So that's a true statement. And since we're looking for the not choice, we don't want to circle choice A. It says account titles of liabilities often include the term payable. This is absolutely a true statement, and in fact, anytime you see an account with the word payable in it, it is going to be a liability. There are zero exceptions to that. Okay? Now, what I am not saying is that all liabilities have the word payable, but whenever you see the word payable, you definitely have a liability. All right. Cash received before a service is performed creates a liability. This is absolutely a true statement. That's called an unearned revenue. We just talked about that in the prior question. Choice D, liabilities include accumulated depreciation. All right. We don't know what accumulated depreciation is yet. If you do know, then you know that that accumulated depreciation is not a liability. We're going to talk about accumulated depreciation later in the course, but for now, what I would really rather you understand is that A, B, and C are definitely liabilities, and that D is dealing with something that we haven't talked about, and so through a process of elimination you can get the correct answer, because you hopefully know that A, B, and C, I think I just made a mistake there. You know that A, B, and C are liabilities. Okay. It says, which of the following situation increased stockholders' equity? Supplies are purchased on account. So in this situation, we have an asset that is going up. That's a good thing. But we also have a liability that's also going up, and it negates it, okay? Because we're buying it on account. So this is an incorrect answer. Our assets went up, but our liabilities also went up by the same amount. Services are provided on account. We've earned revenue, and we haven't increased any liabilities. So we have a net of one arrow going up. This is a good answer. Let's look here at choice C just to make sure. Cash is received from customers on account. Here we have one asset that is going up, cash, but then we have another asset which is going down by the same amount. So these cancel each other out. Okay? When one asset goes up and another one goes down by the same amount, we have no impact. And then up here we have one asset going up and then a liability going up by the same amount. Okay? And then choice D, let's go ahead and put an X by that. Choice D says utility bill will be paid next month. Well, in that situation, we have increased liabilities. We haven't done anything to help out with our assets, so that's going to be wrong. All right, next question says the normal balance, right here, the normal balance of revenue accounts is a credit. Think about a cash transaction. I think we actually had this in another question. I don't know if it was the exact same question or if it was the same concept, but think about it. Cash goes up, it's over here to the left with a debit, therefore revenue by default must be to the right, which is a credit. This is therefore a true statement. Hopefully everybody knew one. If I can get this straight here. All right, right here it says the payment for the monthly rent will require which of the following entries? So now they actually want us to get into some entries. So it says the payment. What do we use to pay stuff usually? Cash. Cash is an asset. Is cash going up or down? Well, we're not receiving it, we're paying it. So we need to find something where we have a credit to cash. Choice A says we're going to debit cash. Well, that's automatically wrong because cash is going down, not up. Choices, let's see, D also wants to debit cash, so that's going to be wrong. Choice B and C, choice B says credit cash and credit rent expense. And choice C says debit rent expense and credit cash. Okay, well, choice B is wrong because we can't do this here. We can't have this entry here where cash is here and then rent expense is here. And these are both credits. Where's our debit over here? This is no good. What we can do, though, is we can go ahead and debit rent expense and then cash is going down, so it's over here to the right as a credit. Assets go down with a credit. So this would be the right format, and so that's going to make B wrong and C correct. We are going to debit rent expense, and we're going to credit cash. Okay? The classification and normal balance of the dividends account is what? Dividends are not an expense. An expense would mean that it's on the income statement. Dividends do not show up on the income statement. So I can actually eliminate choice A and B because they both start off the same way. C, a liability with a credit balance. Well, we're wrong on both accounts. Dividends are not a liability, and dividends do not have a credit balance. D, stockholders' equity with a debit balance. This is your correct answer. So what I want you to understand is that you should not see, now sometimes in a beginning accounting class you will see dividends listed on a balance sheet. That's not really the right way to do it, but we do that sometimes to drive this idea home that that dividends are a stockholder's equity account. Really, dividends are a stockholder's equity account as a reduction to retained earnings. Okay, so we really just see retained earnings, and then whatever the amount for retained earnings is, it's less by whatever dividends we've paid out. Okay, and since we think about this, if we're going to pay dividends, dividends are going up, and what's going down? Cash. So cash must be our credit here, and it's over here to the right. So therefore, dividends kind of by default must be to the left, so therefore dividends would be said to have a debit balance. Next question. This video is starting to get a little long. Which of the following is not true with a double entry accounting system? Let's see here. What does it say? The accounting equation remains in balance. This is kind of a tricky concept for a beginning accounting student. But what we're saying here is we're not saying that all of the numbers, that assets are going to remain the same, that liabilities are going to remain the same, and that stockholders' equity is going to remain the same. What we're saying when we say remains in balance is rather that assets will still equal liabilities plus stockholders' equity. And that is true. Okay, so that's not going to be our answer because it is still true. The sum of all debits is equal to the sum of all credits in each journal entry. This is absolutely a true statement. Therefore, it is the wrong answer. Each business transaction will have two debits. Well, that is not always true. You can have two debits in a business transaction, but you're very, very likely to either have one debit or three or more debits, right? The chance that you will have exactly two debits in a business transaction when you're using the double entry accounting system is actually not a very high percentage. So that is going to be our correct answer. I do want to look at D briefly. It says every transaction affects at least two accounts. That is true. At least two accounts. Look at all of the examples that we provided so far. I had the one right here, dividends and cash. Dividends is one account, cash is another account. That's a minimum of two. Last question, journalizing transactions using the double entry bookkeeping system will eliminate fraud. Well, have you ever heard me say that it would? Have you ever, if you've read your textbook, I have no idea if your chapter 1 mentions the fact that journalizing, what did I say, chapter 1, I meant chapter 2. I have no idea if your chapter mentions this or not. It probably doesn't, but this is absolutely a false statement. In fact, we could actually say that fraud is sometimes perpetrated by the double entry accounting system or bookkeeping system because debits will equal credits. That doesn't mean that we have legitimate transactions or that the proper accounts are impacted. So that statement is absolutely false. All right, let's wrap this video up and we'll do another one immediately.